Good morning, folks. Welcome to the 35th edition of the Weekly Wrap. I hope you've been finding it useful. So last time we were speaking a lot about how valuations were going a little crazy across the art AI world, right? And the S&P 500. So this week we have seen a significant correction in the US markets. As I see the markets till yesterday, the Nasdaq fell 4.7% during the week. And actually yesterday there were significant corrections. I even saw Nvidia falling by about 6.5% in one single day yesterday, and Bitcoin has been falling. I also came across some interesting data yesterday, and I saw that a number of the large investors and even the big reputed guys like Bridgewater have actually been paring down their exposures in the AI related companies, not by a little, significantly. So when I look at this data of Bridgewater, of the famed Ray Dalio, he has been cutting down exposures by 50 to 80% in the large names like Microsoft and Meta, etc. That gives us an idea as to how the biggies are thinking, the experienced investors are thinking. While we have seen the US markets correct, reasons could be many. While we think it is more fundamental that valuations have been going up too much, headlines say that markets are now not expecting another Fed rate cut. Though I'm a little skeptical on that angle of view, because given the pressure on employment, I think the Fed will be looking at rate cuts, if not in the December quarter, in the subsequent quarter. So just because it's postponed by a quarter, I don't think markets should react so intensely. It is more to do with fundamental valuations. Okay, and of course the way that they have been allocating capital, which I will come to in a few minutes. But the Indian markets have been more stable. We have seen the Nifty go up by 1.1% over the week actually. And even though the US markets were correcting, our markets did not correct too much. And let us remember that while the US markets had been rising through the year by almost 18-20%, the Indian markets have been largely flat, going through a time correction, and only on the last few days they've been recovering. Much of this week's market has been driven by large conglomerates, stocks of large conglomerates going up, and then some consumer non-cyclicals going up, and healthcare, and followed by energy. The weaker sectors in the market this time were IT and auto. Auto, I guess, has had a wonderful run. It has been among the top performing sectors for the year to date, and we've seen very good sales happening also during Diwali. Possibly the markets are a little muted now this week because they've seen a good upfronting of the sales that could happen over the next few quarters happening in October itself. So a little fizz going out. That's what I would read into it. Emerging markets also have gone up about 1.33% over the week, rather flattish, though they were up 32% during the year. And Europe also flattish at around 1.8% for the week, about 14% in the year to date. So I think Europe had a good run last year, and now sort of a flatter view on it. EMs have done extremely well. Japan has done very well. Korea has done very well during the year. So EMs as a whole have done pretty well. And the view is that if the dollar weakens further, you will see EMs benefiting more. In any case, given the valuations in the Western world, money has to allocate to markets with lower valuations, which has to be emerging markets. Okay, and coming to the emerging markets part of it, Monday's Business Standard started with a headline that India market valuation at a India market valuation discount to US widens. So it says that most of the time the Nifty was trading at a superior valuation to the S&P 500, and now it is reversed with the S&P 500 trading at a higher PE multiple than the Nifty. So the Nifty is at around a 23.4 times PE, and S&P 500 is now at 28 times PE, about a 15 to 20% valuation premium. And but while we are looking at this, actually, if you're comparing India to emerging markets, the premium remains at 70% plus. It had peaked at around 80% plus. It has narrowed a bit to 75-76%, which is still a high premium. Okay, but most fund managers have downgraded India in their portfolios to a minimum. They've gone underweight India and overweight other EMs. Now that has happened, we think what going forward is that the weight given to India could only improve and not go down further, which is positive. It's probable that we've hit a trough as far as FPI flows are concerned, and the only way to go up from here is up. Okay, so that is where we have, as far as that's where we are as far as valuations go. And again, I would like to refer to the edit that we spoke of last time by Akash Prakash, where his experience with FPIs as he was going in the world was a little disappointing, and he was a little pessimistic, saying that India has no leverage, we don't have AI, we don't have semiconductors, etc., etc. But actually speaking, if you're looking deep into exports, okay, we find that exports have been rather stable. The feel was that exports would have collapsed given the tariffs. Actually, they did not collapse. And as Ajay Shah writes in his column in Business Standard, the striking fact is the absence of a collapse when looking for data up to August. And he's looking at the core exports, taking away gems, jewelry, gold, and petroleum, which could fluctuate for various other reasons. And these core exports have remained stable at $62 billion in August, on the upward trajectory since 2020. And the April tariff did not induce a significant deviation in the exports. Okay, while the August level is a dip from the Q2 peak, it remains structurally elevated over any period before 2024. Okay, and this is a striking contrast with what's happened to China. Okay, China's share in US exports have collapsed from 22% in 2018 to 9%. I'm sorry, I should say that China's share in US's imports, US imports from all over the world, and in those imports, China had a share of about 22% in 2018, and that has fallen to 9.04%. Okay, and on that same comparison, India had a 3.7% share in US's imports. That has fallen to about 3.14% from the peak of 3.7. India's share has been relatively stable as compared to China. Okay, so even if you were to look at bronze and textiles, which have been hit hard by these tariffs, while the tariff has made Indian bronze uncompetitive in the US, it remains competitive in a market like Germany, he says. So it has been rechanneling. So instead of sending the goods to America, Indian exports are finding other markets and exporting to those markets. So as a result, overall exports have been rather decent in that sense. Okay. And the part about India not having AI or semiconductors, which are the hot areas across developed markets, that is actually working to our favor as far as the stock markets are concerned. Since managers and investors have become pessimistic on AI given their valuations, and even markets such as Korea, Taiwan, and China have a significant exposure to AI at high valuation, India is looking as a good AI hedge. Okay, so what was thought of as negative for India as far as the stock markets are concerned, it could turn out to be a blessing, because something that is in a bubble zone we don't have. And So given the valuation premiums reducing, bad news factored in, this actually could be a good sign going forward, and we could be attracting flows. Okay. And on the subject of AI, I came across an interesting article by Tracy Alloway, who is a Bloomberg columnist. And she refers, this is about flipping cause and effect. What was thought of as cause becomes effect, and what was thought of as effect is actually cause. Okay. So this actually, she refers to a research note by Jeff Sott, who had written this article, who had written this paper in times of the global financial crisis, referring to housing. Generally, housing is a result, a good housing market is a result of a good economy. A nice, vibrant economy results in a good market for housing. But in the run-up to the GFC crisis, what caused the fall in the economy was housing. It was a reverse. Because of the high leverage and risk that got built into the market, that the housing actually caused the downfall and the recession. For also because of the finance angle that became overarching in the entire crisis and the problem that happened. And that is what could also be happening in AI, is what Tracy says. This year alone, more than a 350 to 400 billion dollars of investments are going into AI related infrastructure. Okay, the returns from this will take time, and market is still unsure as to what would be the returns from this. And no one party can sustain the kind of infrastructure investments that are happening. So it is a multiple set of companies, and possibly the government coming in at some point of time to backstop this. But as the free cash flow in these companies goes away, private credit will come in, or private credit has already come in to fund the infrastructure. So you see that apart from it being related just to the cash flow generators and the AI users and companies, it is also private credit that has come into a picture. And if this falls, like Geeta Gopinath said, 15 to 20 trillion dollars could be the loss. Okay, so here again, like housing caused a problem, it is AI that could cause a problem. While the underlying businesses may be healthy and having long-term implications, long-term uses for industry and society in general, if a fall in valuation could cause a problem, a serious problem to the financial world and the economy. So, and it is said that now the spending on AI infrastructure is 40% of the US GDP. 40% of the US GDP growth is contributed to by AI spending. So that is the sensitivity. And if anything problem, obviously consumption is going to take a hit, which was the earlier driver of the US economic growth. They're a little intertwined, and we have to be very watchful on these issues, and what I think. And we've been talking about caution on this for a while now, and I think it has been worthwhile to exhibit caution given the kind of market falls that we are seeing. Okay, so the Smart Investor supplement on Tuesday says that smart beta funds lose traction on performance slump. So they've been tracking the flow of funds into smart beta ETFs, and that has fallen to only 0.5% from a peak of 9%. Okay, and that the article says is attributed to the underperformance of these factor funds. But if one were to look at recent returns, some of those factors have outperformed the market. So probably investors are going to see these trailing returns and come back again. The idea is to look forward and take the returns rather than seeing the returns go away from you and then enter the market. So consistency in strategy is very, very important. And any serious analyst would see that there have been periods in the past when these factors have underperformed the broad market. It happens every now and then they recover again. So being consistent in your strategy is important. This is a very fundamental method of investing, and we continue to believe in this method of investing. But of course, having the right mix. Investors tend to run after returns. So one of the best performing factor in the last couple of years was momentum. So they chased momentum, and when momentum fell, markets fell, momentum fell, they lost their confidence in these factors. So it is not a very nuanced, learned view of how to do factor investing, is what is my take. Okay. The ET Wealth has the trend map as usual, and this time's trend map is on sectors. Which sector has done well each year, calendar year, and of course the last 10 years. So the 10-year return crown is won by the metals sector, followed by real estate. So metals delivered a 19.5% CAGR over 10 years, and real estate stock index returned about 18.4, which is a significantly high number. I would not have expected the real estate sector to have performed as well, but it did. And surprisingly, most it figures in out of 10 years, 4 times it is there in the number one or number two ranking. Okay, so why is it that many portfolios don't have a lot of real estate stocks in their portfolio? If you look at mutual funds in general, they have a very, very tiny allocation to real estate stocks, even though they have returned so well. And that could be, number one, the floating stock is low. Number two, corporate governance issues could also be driving that decision to have limited exposure to real estate stocks. So just looking at, again, the top performing sector and not knowing the stories behind it, the facts behind it, may lead you in the wrong direction. Metals being a top performer is, I think the relationship is very clear. India has been a cyclical market, and metals, basic materials, are core to cyclical upturns. Okay, and that's why metals have also performed well. We are not at the opposite end of the cycle. We are still at the mid or growing cycle. So I think sectors related to cyclical upturns will still do well. So in the interim, you may find that valuations a little on the higher side, because we saw non-ferrous metals prices jumping. The commodity prices jumped because of supply issues, and one should be wary of entering commodity producers whose commodity may be temporarily overvalued. Okay, keep that in mind. The worst performing sectors for 10 years was pharma and FMCG. So in the 2025 year to date, the bottom of the chart has been IT with a minus 18.7, and real estate preceding it. So till 2024, real estate was there among the top performing sectors. In 2025, it's in the bottom, given the various worries on the demand side for residential real estate. Let us remember one thing: whenever you see a sector at the bottom, the next place for it is to go up. So these can always be contra calls in general, but please look at the particular valuations before trying to do anything. Mint had some pretty interesting articles in today's paper. There's one about children's and kids' awareness as far as financial personal finance is concerned. The headline is, "Kids are learning the ABC of finance and mastering it too." That's nice to see, right? When we were kids, nobody taught us finance. Of course, we were taught the value of money, and that remains the core of learning about money. So there may be some other ways of doing it, making them aware of markets and different asset classes, etc., that could come in. But I think the core to children becoming more financially aware is for them to understand the value of money. And that is what this article speaks about. So while this speaks about saving and spending and investing and about how kids should not be encouraged with instant gratification, they should be taught the art of delayed gratification so that they don't take wrong decisions and control their spending instincts. So spending is there, investing is there, saving is there. The S that is missing is sharing. So I always think that 3 S's that need to be told to the children. It is saving, spending, and sharing. So unless children all learn to share right from when they are young, the feelings of empathy will not develop in them. They should be taught. Okay, that I think is a core to the whole thing, which is missing in this article. There's another same page has another article by Suresh Radhagopan. Says creating an ideal financial advisor and client relationship based on integrity is what every investor should be looking for. Okay, and this relationship should be built on foundations of zero conflict. The interests of the client and the interests of the advisor should be aligned. So that happens when you are moving away from a commission oriented relationship to a fee based relationship, which can take away all this conflict of interest part. And that is when the fiduciary element comes into play, when you have no conflict in the relationship, in the way the advice is delivered. So even if you're in a fee-based model, Sadhagopan warns that being in a performance-linked fee could still be dangerous. While it seems to be that a performance-linked fee is in alignment with the client's interests, it could very well happen that the advisor who's chasing higher fee may end up taking higher risk to deliver higher returns. And at some point of time, that could hurt the investor a fair bit. Other areas where one should be careful about the relationship and how the nature of advice delivered is, say, a client wants to repay a home loan by drawing the money from the portfolio. So a fall in the portfolio value would impact advisor's fees. So that is where integrity comes into play. If the advisor has integrity close to his heart or her heart and is going by these ethics, he or she would clearly look, analyze, and see whether it is worthwhile for the client to pay off the home loan from the portfolio, and do so even though it may reduce his fees in the interim. But keeping the client's interest in mind is uppermost. Not everything can be framed as rules. Ethics have to come from the heart and be practiced by the mind. So that's all I have for you this week. Do enjoy your weekend. Do enjoy the next week, and see you next Friday.